in 2 weeks? And will the stock market, which is seemingly in a V at the moment, will we experience another V? Well, nobody seems to know. In fact, one of our clients, Gary, he wrote in to say his wife said, I hope it's not the internet recovery plan, you know, WWW, where this just keeps going, bouncing up and down. Gary, I didn't think that was funny at all. Meanwhile, what do you do with your investments? Well, I'll tell you what other people are doing. According to the Spectrum Group, 15% of investors have sold their stocks in recent weeks. 21% have bought. Well, obviously, there isn't a lot of agreement as to what people ought to be doing there. Short selling is at the highest level on record. In other words, investors betting that stocks are going to fall in value. And then there's oil. Oh my goodness gracious. We saw this week a futures contract in the oil market went into the negative for the first time in history. Now, the average price of a barrel of oil is about 25 bucks. Why would a contract go negative? It's creating a lot of confusion among investors and some wondering, hey, is this a time to buy oil with the price so low? Well, look, here's the deal. Let's say you're an oil driller. You pull oil out of the ground and the price of oil is really low. Well, you have a choice. You can either stop producing, stop pulling more oil out of the ground. Well, that's expensive to shut it down and then to restart it later. It might be cheaper to bring the oil up out of the ground and then just pay someone to take it off your hands. Let them store it. Well, that's essentially what's happening. It's a supply-demand issue. It's not only created by the pandemic, you know, nobody's driving, so nobody's using oil the way we were. There aren't airplanes flying like before. And meanwhile, Saudi Arabia and Russia, they decided to get into a trade war. They're the world's biggest oil producers. Well, what a lousy time to have a trade war. They're producing more oil at a very moment that the world doesn't want any. So, yeah, a lot of supply, very low demand, the price goes down. If you're lucky enough to have to drive, well, gas prices are down more than $1 a gallon compared to a year ago, $1.80, and it's probably going to get cheaper in the next couple of weeks because of the current oil glut. Too bad none of us have anywhere to go. So what do you do? Does this represent an opportunity to buy oil? I've also had people saying, Rick, what about gold? Is this a time to buy gold? Because, you know, when the world goes to, you know, a crisis, gold is a great hedge. Well, is it really? Gold fell 21% in the first quarter of this year. The average stock fund is down 25. So gold hasn't done any appreciably better than the stock market has. So what should you do? Well, how about just, you know, focusing on low-cost investments? Well, the lowest cost investment out there is an S&P 500 stock index fund. Let me ask you a question. What's the advantage of buying that? Well, isn't it obvious? These are the 500 biggest companies in America, and isn't that a diversified portfolio like I always advocate? 500 stocks instead of buying just one or just two? Well, think about it. I agree with you. Buying 500 stocks makes a whole lot more sense than buying just one stock. But how would you feel about buying 3 stocks? Here's the crazy thing about the S&P 500. Over the last 5 years, 3 stocks, Microsoft, Amazon, and Apple, 3, accounted for 1/3 of the total return of the entire S&P 500. It didn't really matter what the other 497 stocks did. How crazy is that? If you add Facebook and Google, the 5 of them together account for 40% of the return of the S&P 500. If you look at the top 10 stocks, they account for half of the return of the S&P 500. It doesn't matter what you did with the other 490 stocks. In other words, a cap-weighted index, one that is built based on the biggest companies at the top and the smallest companies at the bottom, and we're going to invest based on the size of the company, you end up putting so much money in the top 10 that it really doesn't matter what your investments did with the other 490. You're not nearly as diversified as you thought you were. So no, I can't say that investing in an S&P 500 index fund is the only thing you need to be doing with your investment strategy. It's not giving you the diversification you think you're getting. And how about hapless investors who were sold a non-traded REIT over the last several years? Due to the crisis, people can't get their money out. Since 2013, $70 billion has flowed into this, and I have never seen a single person who invested in this thing out of their own volition. Honey, you know what? It's a sunny day. I think I'm going to go buy a non-traded REIT. You don't even know what that is, do you? Well, I'm not even going to bother explaining it to you. All I'm simply going to tell you is that these are products that generally pay very high commissions to the salesmen who sell them to you. These are real estate investments that are non-traded. They have no liquidity. And a lot of these, because of so many demands for their money back, many of the managers of non-traded REITs have stopped letting investors withdraw their money. You think you've got a problem with your mutual fund or your exchange-traded fund losing value? How about if you got a phone call saying you can't have any of your money back? That's why we hate non-traded REITs, is one big reason. How about floating rate funds? That was an idea meant to protect against rising interest rates. Well, yeah, they protect against that, but you know what they don't protect against? Losing money if the credit quality of the issuer goes down. So yeah, you might not have to worry about rising interest rates right now, but you got to worry about the company going bankrupt. Floating rate funds, when people try to buy an investment to protect against risks, they end up usually taking risks they had no idea they were taking. And then there are those who are trying to exploit this nonsense. A new ETF is on the market. It's a new work from home ETF.